If you're sitting there with money in a savings account earning basically nothing, wondering if you should finally jump into the stock market, I get it. I was exactly where you are back in 2010. And I'm going to share some hard truths I wish someone had told me before I made my first investment. Because most beginner investing content out there is either trying to sell you something or it's so watered down it's useless. Today, I'm giving you the unfiltered lessons I learned over 15 years of building a dividend portfolio that eventually let me walk away from my corporate accounting job. Lesson 1. Start now, even if you're scared. The biggest mistake I made? Waiting too long to start. It was 2010. I was 29, working as an accountant in Chicago. I had just watched the 2008 financial crisis destroy people's retirement accounts and savings. My coworkers lost 40–50% of their nest eggs. It was brutal. And honestly, it terrified me. I kept my money in savings accounts for almost 2 years after that crash because I was convinced the market would collapse again. I was so scared of losing money that I guaranteed I'd lose to inflation. While I sat on the sidelines, the market recovered and kept climbing. According to historical S&P 500 data compiled by NYU Stern School of Business, the index has posted positive returns in roughly 73% of all calendar years since 1928. Think about what that means. Even with crashes, corrections, and every scary headline, the odds favor long-term investors. When I finally started in late 2010, I began with just $10,000 and then committed to investing $800 a month. Nothing fancy, but here's the thing. I wish I'd started 2 years earlier. Those 2 years of sitting out cost me real wealth. According to Schwab's analysis of S&P 500 returns, someone who invested at the worst possible time every single year, literally buying at the market peak, still earned an average annual return of about 8.4% over 20 years. Think about it this way. You don't need perfect timing. You need time in the market. Every month you wait is a month of potential compound growth you'll never get back. Bottom line, stop waiting for the perfect moment. I wasted 2 years being scared. Don't make the same mistake. Lesson 2. Dividends compound faster than you think. Here's something I got right from the start, but I still underestimated how powerful it would become. Dividend reinvestment. When I started investing in 2010, I focused exclusively on dividend-paying stocks and ETFs. I'd watched growth investors get hammered in 2008, and I wanted something that would pay me regardless of what the market was doing. Let's dive into the numbers. Reinvested dividends accounted for approximately 70% of the S&P 500's total return from 1973 through 2023. When I started, my first dividend payment was maybe $30. Nothing life-changing, but I reinvested it automatically. Every single dividend, every single time. By 2015, 5 years in, I was getting about $200 a month in dividends. By 2020, that had grown to $600 a month. Today, my portfolio generates about $850 a month, and most of that still gets reinvested. Here's what I wish I'd fully understood at the beginning. It's not just about the dividend yield. It's about dividend growth over time. Companies like the dividend aristocrats, those that have increased their dividends for 25+ consecutive years, are building your income automatically. Johnson & Johnson, Procter & Gamble, Coca-Cola. These companies raise their dividends every single year. I've made a detailed video about dividend aristocrats. Make sure to check it out too. So even if you buy a stock yielding 3% today, if they increase that dividend by 5 or 7% annually, in 10 years you're earning 5 to 6% on your original investment. In 20 years, that yield on cost can be 8 or 10%, maybe even higher. The lesson here? Dividend reinvestment is the closest thing to a wealth-building cheat code. Start early and let it compound. Lesson 3. Consistency beats everything else. All right, this is probably the most important lesson from my entire 15-year journey. I started with $10,000 in 2010. Then, I committed to investing $800 a month, every month, no exceptions. Some months the market was up. Some months it was crashing. Didn't matter to me. I invested the same amount on the same day every single month. By March 2020, I had built my portfolio to about $150,000. That's 10 years of consistent investing. No magic, no market timing, just showing up month after month. The thing about consistency is that it removes emotion from the equation. I wasn't trying to guess if the market was too high or too low. I just invested. According to research from Vanguard on dollar cost averaging, investing a fixed amount regularly helps smooth out market volatility. It removes the psychological burden of trying to time your entry points. In 2011, people said the market was too high. In 2013, everyone was worried about the fiscal cliff. In 2016, it was the election. In 2018, it was trade wars. There's always a reason not to invest. But you know what? I invested through all of it. And by staying consistent, I captured market dips automatically. When prices dropped, my $800 bought more shares. When prices rose, I still got my shares. Here's the real kicker. When COVID hit in March 2020 and my portfolio dropped from $150,000 to about $110,000, I kept investing. Actually, I increased my investments during that crash because shares were on sale. The investors who succeed aren't the ones who are smartest or who time the market perfectly. They're the ones who develop a plan and execute it consistently, month after month, year after year. My rule now? Automate your investments. Set it and forget it. Remove your emotions entirely from the process. Lesson 4. Low fees are a non-negotiable. Here's something I got lucky with early on. I accidentally chose low-cost investments. When I started, I didn't want to pay trading commissions, so I focused on ETFs I could buy commission-free. I didn't want high-expense ratios eating into my returns, so I chose funds with fees under 0.1%. I thought I was just being frugal. Turns out, this decision probably saved me tens of thousands of dollars. Let me give you some shocking figures. According to analysis from the Securities and Exchange Commission, a 1% annual fee on a $100,000 investment growing at 7% annually will cost you approximately $28,000 over 20 years. A 2% fee? You're looking at about $50,000 in lost wealth. Think about what that means for my journey. If I'd paid 1.5% in fees on my investments instead of a maximum of 0.1%, I'd have tens of thousands less today. The data tells a story the financial industry doesn't want you to hear. Research from S&P Dow Jones Indices shows that over a 15-year period ending in 2023, approximately 90% of actively managed large-cap funds underperform the S&P 500 index. So you're paying higher fees for funds that can't even beat a simple index fund over the long haul. Here's my core holdings today. SCHD, expense ratio 0.06%. VYM, expense ratio 0.06%. Individual dividend aristocrats with no ongoing fees. These low-cost choices meant more of my money was actually working for me instead of enriching fund managers. Bottom line, every dollar you pay in fees is a dollar that's not compounding for your future. Choose low-cost index funds and ETFs. Be ruthless about minimizing expenses. Lesson 5. Your emotions will try to sabotage you. This is the hardest lesson I've learned, and honestly, I'm still working on it. The market doesn't beat investors. Investors beat themselves. March 2020, COVID hits. The market crashes 34% in just over a month. My portfolio drops from $150,000 to about $110,000 in the span of a few weeks. I'm sitting in my apartment, working from home, watching my account balance crater, and I was terrified. Every instinct in my body was screaming at me to sell everything and preserve what was left. What saved me? I remembered watching people panic sell in 2008 and lock in their losses. I'd seen coworkers sell at the bottom, then sit on cash and miss the entire recovery. So I did something that felt insane at the time. I kept investing. I actually increased my monthly contributions during the crash because shares were cheaper. According to data from Dalvar's quantitative analysis of investor behavior, the average equity fund investor significantly underperformed the S&P 500 over 20-year periods. Why? Because people buy high when they're excited and sell low when they're scared. My dividend stocks? Most of them kept paying. Coca-Cola, Johnson & Johnson, Procter & Gamble, they all maintained or even increased their dividends during COVID. That cash flow staying stable helped me resist the panic. The market recovered all those losses within 5 months. If I had sold, I'd have locked in a $40,000 loss and probably missed the recovery because I would have been too scared to get back in. According to data from First Trust, analyzing S&P 500 performance since 1980, the index has experienced an average intra-year decline of about 14%, yet still finished positive in most years. Think about what that means. Temporary drops are normal. They're the price of admission for long-term wealth building. Here's my system now. I made all my investment decisions when the market was calm. I wrote down my plan, what I'd buy, when I'd buy it, and that I'd never sell in a panic. When March 2020 hit, I followed that plan instead of my emotions. Bottom line, your emotional reactions will cost you more money than any market crash. Make your plan when you're calm. Execute it when you're scared. Look, I've given you 5 lessons that took me 15 years to internalize fully. Let me wrap this up with the big picture. I started investing in 2010 with $10,000 and $800 a month. I made mistakes. I waited too long to start. I underestimated the power of dividend compounding. But I got some things right too. By March 2020, that consistent, boring, disciplined approach had built a $150,000 portfolio, generating about $600 a month. That's what eventually gave me the confidence to walk away from my corporate accounting job and build life on my own terms. Today, my portfolio sits at about $215,000, generating roughly $850 a month. It took 15 years, no shortcuts, no magic strategy, just consistency, low fees, dividend reinvestment, and controlling my emotions. The investors who succeed aren't necessarily the smartest. They're the ones who start early, stay consistent, keep costs low, and don't let fear make their decisions. So here's my advice to you. Stop overthinking it. Open a brokerage account today. Start with what you can afford, even if it's just $100 a month. Choose a low-cost dividend ETF like SEHD or VYM. Automate your investments and give yourself the gift of time. Your future self will thank you. Remember, this is educational content based on my personal experience and publicly available market data. Do your own research and consider consulting with a qualified financial advisor about your specific situation. If this helped you, hit that like button and subscribe for more no-nonsense investing content. And if you haven't seen it yet, check out my video about how I actually quit my corporate job to live off dividend income. I break down my entire portfolio and the exact numbers. I'll see you